Welcome back to the Deep Dive. Today, we're really taking a close look at the credit scoring world, specifically FICO. We've gone through their Q4 and full fiscal 2025 earnings call, the data, everything.
Right.
And we want to unpack two really big strategic moves. These aren't small tweaks.
No, definitely not. This is like major shifts, trying to grab more market control, change how schools are sold, especially in the huge U.S. mortgage market. It's like $12 trillion we're talking about.
Exactly.
So look, if you care about financial infrastructure, this is pretty crucial stuff. FICO isn't just reporting numbers here, they're making a strategic pivot.
Okay, so what's our mission for the listener today?
Right, mission is pull out the key financials that, frankly, gave them the confidence for this pivot. Because 2025, it was a record year. All key metrics, record cash flow.
Confidence is key there.
Then we need to decode this new Mortgage Direct License program. It's FICO basically going around its usual partners.
Interesting. Sidestepping the bureaus.
Pretty much. And then the second part is innovation. We need to talk about their newest model, FICO 10T, and their push into AI, specifically these focused foundation models.
So using that financial strength to lock down the present and build the future.
That's the frame. Stability funding aggression, you could say.
All right, let's start with that financial foundation. It sounds like it was pretty impressive.
Oh, it was. Fiscal year 2025, they actually beat their own guidance. Total revenues hit $1.991 billion.
Almost $2 billion. Wow.
Yep. And that's up 16% compared to the year before. And it wasn't just, coasting at the end. Q4 was strong, too.
Okay, what were the Q4 numbers?
$516 million in total revenue for the quarter. That's a 14% jump year over year.
Solid growth. But, for me, it wasn't just the top line. It was the efficiency underneath.
Absolutely. That's where it gets really interesting. Sustained profit expansion. Their non-GAAP operating margin, get this, hit 54% in Q4.
54%? That's huge.
It is. It's a 210 basis point improvement over the previous year. Just think about that margin for a company this size in software and data. It's incredibly strong.
That kind of margin, give you options. Strategic firepower, like you said.
Definitely.
Okay, let's dig into the scores segment. That's always been the cash cow, right?
Right. Historically, yes. Scores revenues were $312 million in Q4. That's up a whopping 25% year over year.
25%. And what's pushing that so hard?
The main driver is B2B scores, business to business. They were up 29%.
Okay.
And if you look inside B2B, you have to look at mortgages. Mortgage origination revenues saw a massive 52% increase year over year.
Hold on. 52%. But weren't mortgage volumes kind of choppy, maybe even down a bit with interest rates?
Exactly. That's the key point. The source material, the call itself, was very clear. This growth wasn't volume.
So it was price.
It was primarily a higher unit price for the mortgage origination score.
Wow. Okay. So if volumes are flat or down and revenue in that bit jumps 52%, that tells you FICO has just incredible pricing power in mortgages.
Unparalleled, yeah. They can raise the price significantly, and the market just has to absorb it because that classic FICO score, it's the mandated standard for conforming loans.
That's market power right there.
It really is. But it wasn't just mortgages showing strength.
Oh.
Auto originations were up 24%, and then credit card, personal loans, that whole other originations bucket, up 7%.
So stability and pricing strength pretty much across the board in lending.
Seems like it, yeah.
Okay, let's switch gears then. What about the software segment? I saw revenues there were flat year over year, around $204 million.
Correct. Flat top line there, which, might make you pause.
All right.
But that flat number, it kind of masks this really crucial shift happening internally. They're moving towards the platform. FICO platform revenue actually grew 17%.
Okay. So it's a transition story within software. Legacy down, platform up.
Exactly. They're managing the decline of older products while scaling the new platform business. And the sales numbers. They back this up.
How so?
Their ACV bookings, that's annual contract value, hit $32.7 million in Q4. That was their strongest quarter for ACV in 6 years.
Strongest in 6 years. Okay, that's significant momentum.
Yep, and it pushed the full-year ACV bookings over $100 million to $102 million.
And what about keeping those platform customers? Stickiness.
Good question. Platform annual recurring revenue, ARR, grew 16% year over year. It now makes up 35% of their total software ARR in Q4.
35%.
Wow.
Growing share.
But the number that really shouts confidence is the dollar-based net retention rate, DBNRR, for the platform specifically, 112%.
112 DBNRR. So just to clarify for listeners, that means existing platform customers on average spent 12% more with FICO this year than last year.
That's exactly right. It's not just about signing new deals. It's about current customers using more, expanding, embedding FICO deeper into their operations.
That's the sign of a healthy platform, expansion revenue.
That's the engine for long-term value right there.
Okay, so you've got this incredible financial stability, these fat 54% margins, a strong scores engine, and momentum in the platform business. It makes total sense now why they'd feel confident enough to, well, launch something as bold as this direct license program for mortgages.
It's a huge move, a strategic nuclear weapon, as you put it earlier.
Yeah.
Let's unpack that.
So what's the goal? What problem is it trying to solve in that $12 trillion mortgage market?
The stated goals are driving competition, transparency, and importantly, cost savings, plus modernizing the whole credit infrastructure.
Okay. And how does it work? You mentioned bypassing the bureaus.
For decades, right, FICO scores only came through the three big credit bureaus.
Yeah.
Equifax, Experian, TransUnion. This new program, it cuts them out of that specific distribution chain for mortgages.
No.
It lets these companies called tri-merge resellers. Think of Zactus. They signed a big multi-year deal already. They're major players. It lets them calculate and distribute the official FICO scores directly to the mortgage lenders.
Directly.
Okay.
So the resellers get the algorithm or the connection?
They get the license to calculate and distribute. It sends like a shockwave to the bureaus.
Because it removes their control over that distribution and their markup.
Exactly. Their control and, critically, their ability to add that significant markup on the FICO score itself.
Now, FICO seemed very keen to say this doesn't add risk or complexity. Is that right?
Yeah, they stress that point heavily. The underlying data, the format Freddie Mac and Fannie Mae require, the actual FICO score algorithm, it's all identical to what the bureaus use right now.
So the resellers already have the pipes, basically.
The infrastructure's there on the reseller side.
Right.
So for the mortgage industry itself, there shouldn't be any added complexity. Smooth transition is the idea.
But what does change dramatically is the cost, right? And the pricing. You mentioned options starting in 2026.
Yes, two models for lenders. First is what they call the historical per score model. That's priced at $10 per score.
$10, which wasn't that roughly what FICO said the bureaus were marking it up to anyway, from FICO's old price?
Precisely. They noted that $10 matches the average markup the bureaus applied to FICO's 2025 price, which was $4.95.
So FICO's saying, look, we know the market pays $10, but we've got a better offer.
And that better offer is the second option, the new performance pricing model. This one is priced at $4.95 per score up front.
Okay, same as the old base price.
Plus a funding fee that's only paid if and when the loan actually closes.
Ah, okay, let's pause there. Performance pricing.
Yeah.
That sounds clever. What does that achieve? For the lender and for FICO?
For the lender, FICO calculates this works out to about a 50% reduction in the average per score fee compared to what resellers paid in 2025.
50% savings? That's huge. Lenders will love that.
Immediately appealing, right. And for FICO, this model is designed to capture the value of their intellectual property further downstream.
Downstream, meaning after the loan is originated.
Yeah, because the FICO score's value doesn't just stop at the lender's desk when they approve the loan.
Right, it gets used everywhere. For pricing the mortgage-backed securities investors buy, by the rating agencies assessing those securities, setting capital requirements for banks.
Exactly. So by tying that second fee, the funding fee, to the successful closing of the loan, FICO connects its revenue directly to the whole mortgage funding process working smoothly.
They only get that extra bit if the loan actually funds.
Precisely. They profit when the ecosystem works, when the borrower gets the house. It's a really profound realignment of financial incentives.
It almost turns FICO from just a cost center input into like a partner in the market's liquidity.
That's a good way to put it. They're betting on the health of the system they score.
Okay, so FICO is clearly disrupting distribution and pricing,
Yeah.
but they're also innovating on the tech side, right?
Mm.
FICO 10T. Let's shift to that.
Right. But first, it's crucial to remember the baseline, the classic FICO score. That's still the required one for conforming mortgages, the ones backed by Fannie and Freddie.
The GSEs, yeah.
And FICO keeps hammering this point. Classic FICO is the only score proven through a full economic cycle, including the Great Recession. Their argument is stability, predictable performance.
Stability as the key differentiator. Got it. But 10T is the future, presumably, aimed at today's market.
That's the positioning. They're calling it the most predictive and inclusive score out there.
Inclusive? How are they making it more inclusive?
By using trending credit data, so looking at payment patterns over time, not just a snapshot, and by incorporating alternative data sources.
Like what? Rent payments, utility bills.
Exactly. Rental payments, utility data, telco data. And, FICO's quick to point out they aren't brand new to this.
Yeah.
They've used rental data in some models since 2015.
Okay. And what about the most predictive claim? How are they backing that up?
They made some bold claims. They stated FICO 10T identifies 18% more defaulters in that crucial sort of middle risk score band compared to their main competitor, VantageScore.
18% better identification of defaults.
Yeah.
And what does that mean practically for a lender using 10T?
The translation is, a lender could potentially increase their mortgage originations by 5%.
Okay.
Without taking on any additional credit risk. Because the score is better at separating risk, you can approve more loans safely at the margin.
More loans, same risk profile. That expands the market.
Expands the market,
Yeah.
potentially helps borrowers who might have just missed out under older models.
Is it getting adopted outside the conforming space, I mean?
Yes. They mentioned nearly 40 lenders already using FICO 10T. These are in the non-conforming mortgage world. That's still a big chunk of the market, over $316 billion in originations annually.
So it's gaining traction.
Yeah.
What's really interesting, though, is how FICO positions even its old scores against competitors.
Yeah, the comparison with VantageScore 4.0. FICO cited several independent studies, Milliman, Urban Institute, AEI Housing Center,
Okay.
that found the classic FICO score, which is like 20 years old now,
Right.
performs similarly to, or in some cases actually outperforms the much newer VantageScore 4.0.
Wait, the 20-year-old score holds its own or beats the latest competition, according to independent studies.
That's the claim FICO highlighted. It's a pretty powerful statement about the quality and, frankly, the entrenchment of their original IP.
Did they offer any specific criticisms of why the competing models might underperform?
They did. They specifically called out some competitive models as being, quote, statistically unsound for predicting risk. For example, trying to generate a score based on just 1 month of payment history.
1 month. Yeah, that sounds thin.
FICO's take seems to be that the core methodology of some competitors is flawed, no matter how much alternative data you layer on top.
Which brings us neatly to their own AI push. This feels like the next defensive and offensive layer. FICO FFM.
Right. The FICO-focused foundation model for financial services. It includes components like FICO FLM and FICO FSM.
So focused being the key word there. How is it different from general AI?
Exactly. It's their answer to the whole Gen AI hype. Instead of a massive do-everything AI, FFM is domain-specific, tuned just for financial tasks, compliance, decisioning.
Which makes it auditable, transparent, less prone to weird outputs.
That's the idea. In finance, you can't have hallucinations or black boxes making decisions. Regulators won't accept it, so focus and explainability are key.
Makes sense. What kind of performance lift are they claiming for this FFM?
The numbers are pretty dramatic, especially on the efficiency side. They're saying FFM delivers a 35% or greater lift in performance for transaction analytic models.
Like fraud detection, anti-money laundering.
Yeah, exactly. Those super high-speed analyses. And crucially, it does this while requiring up to 1,000 times fewer computational resources than conventional Gen AI models.
Whoa, okay. 1,000 times fewer resources. Let's translate that. That means huge cost savings on computing power.
Right.
Faster deployment, probably more predictable performance because it's simpler.
All of that. FICO's essentially building these custom, high-performance, audit-friendly AI tools tailored specifically for banks and financial institutions.
Giving their customers an edge in speed and efficiency without the headaches or risks of using a giant general AI for regulated tasks.
That's the value proposition. It shows they're looking beyond just the consumer score, deep into institutional decision-making, keeping FICO tools relevant in this digital transformation era.
Okay, so stepping back, it really feels like FICO is executing this twin strategy very deliberately. Track 1. Squeeze more value out of the existing dominant classic score with this direct license program. Use that performance pricing to capture more value downstream.
Monetize the present, maximize that entrenched position. Yeah.
And track 2. Invest heavily in the future. The cutting-edge, but importantly explainable, AI, like FFM, and the next-gen predictive models like FICO 10T.
Optimize the present while building a highly efficient, defensible future. That sums it up pretty well.
And that performance pricing piece in mortgages, it feels like the most subtle but maybe most profound shift.
I agree. Tying a chunk of their fee directly to the loan funding, It aligns FICO's own financial success more closely than ever before with the actual health and liquidity of that whole $12 trillion mortgage market.
They win when the system wins.
They're betting on the long-term stability of the market they underpin. It's ultimate strategic confidence.
It really is.
Yeah.
Which leads to maybe a final thought for you, the listener, to chew on. FICO clearly believes in its tech, right? They're saying their 20-year-old score still competes with or beats modern rivals.
Mm-hmm.
So the question is, how much better does FICO 10T actually need to be? What level of proven predictive superiority and maybe what level of lender demand will it take before the GSEs, Fannie and Freddie, are finally pushed to adopt it across the entire conforming mortgage market?
That decision, whenever it comes, could be the next massive catalyst in the entire credit ecosystem.